Kitco Mining special coverage of the Mining Forum Americas is brought to you by Metallo Royalty and Streaming.
Is gold becoming overbought? Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 Mining Forum Americas in Colorado Springs. Joining me today is Florian Grummes, Managing Director of Midas Touch Consulting. Florian, welcome back to Kitco.
Thanks for having me, Paul. It's always a pleasure to be with Kitco.
Gold is at $3,600 per ounce. It's touched $3,700 per ounce, and potentially there is a lot more to come. What have been some of the key drivers that have got us to this point in time?
Well, first of all, the physical market. I think that's really, really important that people understand that the price is not really being made at the COMEX anymore and at the LBMA in England, but it is in Dubai, in Shanghai, and in Mumbai. The physical demand, especially from the Chinese, the emerging market central banks, and also from Tether. They're buying physical gold every week. So that's forcing basically the unwinding of 5.5 decades of paper gold price discovery, basically. So everybody knows it in our industry. Over the last 5.5 decades, more and more paper ounces, at some point 150 to 200 paper ounces of gold, we're discovering the price for one real physical ounce. And that's coming to an end. That's unwinding. It's a process maybe even over many years to come. It's not something that happens overnight at the moment. Maybe at some point in the future it will, who knows. But I think that's the most important driver. Then you have, of course, a bear market in bonds. So if you are an institutional investor investing and seeking safe, conservative investments, long-term investments in the bond market, and you have a bear market, it's very difficult to continue with that strategy. So the only alternative they have is physical gold. That's another driver. And of course, M2 money supply expansion all over the world, whether it's in America, in the European Union, Japan, China, everywhere you go. Basically, if you break it down, the governments and central banks are printing money out of thin air.
A key part of the gold narrative in the Western Hemisphere is the expectation that the US Federal Reserve will cut interest rates in the very near future. One of the questions is by how much and how quickly. The only question seems to be on how much will it cut. As and when that happens, Florian, what will that do to the gold narrative?
Well, I mean, we are in an established bull market. We're maybe going to see a little bit more of volatility around the event and the press conference. Personally, I don't pay too much attention to it anymore. I believe actually that the market is telling Mr. Powell what to do. We've seen that already during the time when he started hiking in 2022. It was the bond market basically telling him we want to see higher interest rates with these inflation numbers. So I don't think that the Fed and Mr. Powell are really in charge here. And I also think that most of the market participants give way too much weighting to those numbers or those interest rates. I think the world is much more complicated, and I think there's factors much more important than what the Fed is doing nowadays. And as I just mentioned, I think the physical demand is the most important thing. And then it's also, it's a psychological thing. The markets are always between fear and greed. And I believe we are in a crack-up boom that drives everything higher. So M2 money supply expansion is probably the most important, and they can lower interest rates, of course. That will make people even more bullish, and certainly to an extent this is already priced in. So you might get a little bit of a pullback during or after the press conference, but overall I think we are in a nicely established new uptrend in gold since third week of August. So basically this is, I don't have any indications that we've seen a short-term top.
It must be an unenviable task to be in Jerome Powell's position. As you mentioned, the markets are telling him what to do on one hand. On the other hand, US President Donald Trump is trying to tell him what to do. It sounds from your comments that he doesn't have any control anyway. Goldman Sachs said gold could rally up to $5,000 per ounce because of perceived threats to the Fed's independence. I was going to ask you whether that's realistic, but given the nature of your comments, let's sort of talk about where gold could go, regardless of what the Fed does. Our good friend Ronnie Sturfley, author of the In Gold We Trust report, his model previously was looking at gold going up to $4,800 per ounce. He told me this week that the model is now predicting far higher levels for the gold price. What's your view on where gold could go?
Well, you always have to differentiate regarding the time frame, right? I think that's anyway one of the most important questions people should always ask when it comes to price predictions and general talk about the markets. So in the short term, I think gold beautifully broke out of this 4 months triangle pattern, and it gives us a price target at 3,750-ish. So we nearly went there in a very short period of time. I think that's very realistic to see rather sooner than later. Then you have the round psychological number of 4,000, which somehow always works in the market. So I think the market wants to see the 4,000 also rather soon. Then if you do a measured move from that leg up since December last year, when also gold was consolidating in a triangle formation, and then moved up to 3,500. If you take that like $930 move and you add it to the breakout level now in August, you end up at 4,300 to 4,400-ish. So those are the near-term targets that I have. After that, another round number, 5,000 obviously. And in the longer run, I mean, Kitco viewers know very well that I'm a 5-digit gold bull. So I think we're going to see at some point 10,000, maybe 15,000. Look, I mean, if they really start printing like crazy, well, there's totally different numbers possible as well. I mean, Bitcoin went to over 100,000, so nobody would have thought of that 10 years ago. So, I mean, there's lots of potential scenarios down the road. You want to hold on to your physical gold. I think that's the most important asset that you can hold nowadays. And it's a clear bull market. Your job is to buy the dips. You need to be patient. Don't get overexcited if things go kind of vertical like they did in the last few days and weeks. But if you're patient, there will be some pullbacks, buy the dip, and then just hold on. It's a strong bull market. It's a secular bull market.
At what point do you think gold becomes overbought?
It is overbought if you look with the classical, typical indicators or oscillators that one might use. Monthly chart, weekly chart, daily chart, they're all rather extended and overbought. But that's the nature of a bull market. So again, I haven't seen any turnaround signals. We had a little bit of a pullback now at 3,700 down to 3,660-ish, I think. But the market immediately comes back. And again, I mean, this is the physical market. So it seems that many players just waiting on the sidelines for any little pullback to step into the market. So I think this trend is going to continue despite overbought setups. So.
Okay, let's bring silver into our conversation. Silver is now joining the party. Recent weeks have seen it jump from, let's say, that breakout from that 30, 35 US dollars per ounce range up to 40 and beyond, 42, 43 US dollars per ounce. What has made silver suddenly jump and come into the party?
Well, I mean, generally, silver is most of the time following gold, and it was time to break above $35. I mean, well, I've said it last year, about a year ago, I said we should see silver around $50 next summer. Seems like I've been a little bit too optimistic, but here we are. It's catching up nicely. It's broke out now just very recently out of this long uptrend channel that it had since the COVID crash. So it's actually now starting its acceleration phase. And coming back to your overbought question as well, like usually once you see silver really starting to spike and doing its own thing, that's where you want to get or become a little bit more cautious, because that usually brings in a short-term top in the metals. But we haven't seen that either. There's many reasons. I mean, look, the gold-silver ratio is still extremely high. If you dig in the ground, you will find probably 9 ounces of silver for 1 ounce of gold. At bull market tops in 1980, in 2011, the ratio topped at 35. In 1980, it topped at 15. We are far away from those levels. So I think silver is still extremely undervalued and has a lot of catch-up to do. We know strong physical demand out of China, India, solar industry. Even the Saudis, the central bank announced that they started small position, but they started to buy SIL and SLV. So I think, silver is coming. We need to be patient. It's still cheap. It's still very undervalued, but it will come. I'm a big silver bull in the mid to longer run.
Okay. The gold price has hit many record highs this year. Silver's still about $8 from its record high. Inflation adjusted, that would go up to sort of 60 or 70 US dollars per ounce. So silver on that level still has a long way to run. Let's bring in the gold stocks themselves. The gold miners have started posting some really good results on the back of the strong metals prices. The gold stocks are starting to soar and outperform even the yellow metal. Some companies up more than 100% year to date. The GDX, the gold miners at 52-week and decade highs, the NYSE Arca gold index as well. But despite being at high levels, the GDX is still experiencing outflows. There does seem to be a bit of a conflicted or confused signal here.
Yeah. Well, I think, let's face it, this whole bull market in precious metals, in gold especially, is not driven by Western investors, right? So far, it's been, again, the physical demand from China, especially that has been responsible for the price levels where we are today. And the excitement for other sectors like AI, like crypto, etc., has still not brought back too many generalists in our sector. But I have the feeling here at this conference, I bumped into quite a few people that are here for the first time. Of course, they all start with Barrick as a first position, but I think it's coming here. And you see, suddenly in the summer doldrums, suddenly the mining stocks wake up, and they rallied very hard the last 3 weeks. So I'm optimistic that this will change. I wouldn't give too much weighting on the outflows of the ETFs themselves. And most importantly is always the price action. The GDX has rallied back to its 2012 high very quickly now in the last few weeks. Of course, that's a natural resistance. It's overbought, so I wouldn't be surprised if we get a bit of a larger breather here. But I think coming 2026, this whole bull market will gain more steam and accelerate. So I'm optimistic in the longer run. In the short run term, it's a little bit challenging because we had these steep, massive run-ups, and most investors who participated and were lucky enough to catch that move are now in that situation. Let my winnings run, or I pay myself when the market makes money available. And you need to find, I think, somewhere in the middle. That's probably the best way to go. So I'm taking some money off here and there. I don't sell the whole position. I scale down a little bit, trimming down maybe 5, 10, 15, 25%, but not more. Because I think we are in a secular bull market, and the mining stocks have still a lot to come. So,
As I prepared my notes for this event, Florian, I was looking at share price charts, and as you mentioned, some of the blue chip, the main miners, the big miners, they're up triple digits, 100%. Some of the developers, 200, 300, 400%. Those are very attractive gains for any investor. So it seems that those kind of gains will attract the generalists. But I imagine one of the questions they will have is, given that how hard companies have run or share prices have increased in recent months, have I missed it?
Yeah, if you were not invested or were not holding any of those stocks that exploded over the last few weeks, it's a bit of a difficult situation right now because the train has left the station. I just laid out why I believe in the long run, many of those mining stocks will see much higher prices. But in the short term, I wouldn't be surprised if we're going to get some pullback maybe into the fourth quarter. Typically, gold sees some seasonal weakness into October and then especially November, and then a turning point in mid-December. So you're running behind the train, and we also know that mining stocks can quickly pull back 30, 40, 50% without any change in fundamentals. So I would be very cautious. The problem, of course, is if you try to figure out and find a stock that has not moved yet, then the question, of course, is what's wrong with you guys? Why haven't you moved yet? So it's a bit of a challenging situation right now for people who have missed that move. But I think, as I said before, buying the dip, that's our job in the bull market. So we have to be patient. There will be dips along the way. And then you have to be jumping in with both feet, basically. So we're going to see some buying opportunities down the road. But I wouldn't chase them right now.
Well, I think for any investor who fears they might have missed the move in the miners, the message from most of the CEOs I've spoken to here at the event is that they're still undervalued. So if you take them at face value, there's still opportunities there.
Oh, yeah, no, there's huge opportunities, but you have to be a little bit patient. In the end of the day, it's all trading and investing, it's all about managing your own psychology in the end of the day, right? So you don't be too greedy when there is like a big party basically going on right now, and you're not too afraid when everybody's panicking. You have to do the opposite, and it's very challenging and difficult. So I would say right now, let your winnings run and maybe take some profits here and there, a little bit trim down positions just to have some cash for new opportunities, which I believe are coming in the next few months. And if you have not invested at all, I mean, as long as you have physical gold and silver, you're already good. And building more positions in the mining space, on pullbacks, for sure.
Throughout the remainder of the year, Florian, what are some of the key things you're watching out for, both in terms of the precious metals themselves, but also the miners? What are some of the key data points or signals you're looking for?
Well, first of all, I think it's important to be aware there is the Golden Week in Shanghai, first week of October. Trading, buying, selling, everything shuts down in China. People are on holiday, traveling the big country. So that gives the paper shenanigans in the West an opportunity to basically hammer down on the gold prices. That's something we always need to keep in mind. Then, lots of conferences coming up in October and then especially in November. Other than that, I don't see too many specific important... I mean, let's face it. Normally, mid of October, you have the start of the Santa Claus and the year-end rally in the stock market. We're still seeing more or less the typical weakness into September, mid of October. So if we get a turning point in the stock market and then also, of course, in Bitcoin, that could basically stop that safe haven buying into gold and maybe put some selling pressure on gold for maybe a few weeks. So those are the dates, I think. Yeah, that's what I'm looking for.
Excellent. Well, Florian Grummes, thank you very much for joining us today.
Thanks for having me, Paul. Always a pleasure.
And we have a lot more to come from the 2025 Mining Forum Americas, so hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining special coverage of the Mining Forum Americas is brought to you by Metallo Royalty and Streaming.